Okay, so thank you once again for following our videos, and also you are welcome to Executive Masterclass Tutorial Center, where that we are coming to start our let's say the part 3 of our management accounting, and this section is going to cover the same topic, which is short-term decision, but this one will be a subtopic under which is what make or buy decision that organizations make. So one issue is that organizations make decisions whether they should make a particular, let's say what that they are producing, or sometimes they can buy it, or they can outsource it. So we are going to see some things that we need to consider before we will make a decision whether we should produce whether we are maybe an order we have received from a customer, or we should outsource it. So there are some things that we should know. Organizations have to, before they will make a let's say make a decision on make or buy, they need to consider the resources that they have. So whether they have limited resources, they have unlimited resources. So we need to know this. So limited resources and unlimited. If an organization is having a limited resource in their production, it is kind of different when it comes to when they have unlimited resource, because some of the resources that it is available to organizations for them to use are machine hours. They can also have, let's say, labor hours, funding, and let's say also materials that they use. These are the resources that is always available to let's say organizations. So an organization which has limited resources find things difficult when it comes to their production. But if an organization is having unlimited resource, it means that there's a spare capacity. There's a lot of stuff that they have that they can base on it to make their decision. But the issue is that even though an organization might be having all the resources, but they might also think of it by not producing a particular let's say project that they have received from a customer by themselves, but they can also outsource it. So they can also think of whether they need to outsource the project, or they need to produce it by themselves. But the issue is that the moment, anytime you are going to outsource it, you need to think about some things, because you are sourcing your work to somebody to do it. Then you need to think about some stuff. The quality of the product that the outsourcer will give it to you when they produce it, and also you check your, let's say, the confidentiality that you have with that outsourcer. You need to also check the expertise, the expert that they have when it comes to the production of the product that your customer, or let's say your customer has requested from you. And also you need to check lead time, because time availability is one of the factors that you need to check, because if your customer need the order within some short period, and the outsourcer will not able to give it to you, therefore I bet you that maybe by the end of everything it can be an issue. It comes in with a legal stuff and things. So we need to make sure that before you are sourcing the work to an outsourcer to do it, you need to make a very, very good checks before you do it. So an organization might have a limited resource, or they might have unlimited resource, but they can still make they can still make decisions whether they should make the product in-house, or they should let's say outsource it. So if an organization want to, what that they do is that they need, if you want to know whether they should make or they should let's say buy, therefore they first need to check on the marginal cost of making the product. So marginal cost, the marginal cost that they will incur when they produce the product in-house, or they make the product in-house, and also the buy-in price. The buy-in price. The buy-in price. So if you are going to buy it outside, what will it going to cost you? Or if you are sourcing it to an outsourcer, how much are you going to pay? So you compare these two. If when you produce it by yourself, and you are going to incur, let's say, a lower cost than you buying it, therefore it is best that you make it in-house. And also if you are going to, let's say, buy it outside from an outsourcer, and the cost is lesser than you making it in-house, it is best that you go for it. So I'll give you the decision rule, but this have that the things go. Even though an organization might have unlimited resource, but they have to make a decision based on this aspect. So these are some of the things when it comes to the marginal cost, the cost that an organization can incur. Variable cost. So they need to check their variable cost. Then they will add. They need to also add their specific fixed cost, or specific cost that they will incur. So you know general fixed cost or general overheads is not included as what relevant cost. So you need to check their specific fixed cost or any specific cost that you incur. That one that you can add it as part of what when it comes to the marginal cost. The variable cost consists of direct material, direct labor, direct expense, and variable overheads. So these are things that we need to consider. When you add these two together and you compare with the buying price and the marginal cost is less than the buying price, then the decision is telling us that we should what? Make the what? The project in-house. But if that the buying price is lesser than the cost we incur in making it in-house, therefore we need to make decision of what? Buying it. So that's what that means. So we should know that general overheads is not considered when making the decision about what make or buy. Note that general overhead is not considered when you are making a decision on what? Make or buy. We should note it. So let me give you the decision rule. The decision rule. The decision rule is saying that where marginal cost is greater than buying price, you should do what? If the marginal cost is higher than or is greater than the buying price, then we need to go and buy. You need to buy it. Also, when the marginal cost is less than the buy-in price, then we need to make it. So ladies and gentlemen, these are the decision rule that we need to what? Undertake. Anytime we find ourselves in this scenario, we need to make this decision. That's what our organizations do. So we have to do the same as well. So that's it when it comes to the decision rule, when it comes to make or buy decisions. But one issue is that you see this scenario that I'm giving you, it's when the organization is having what? Unlimited resource. The same thing that they can what? Make decisions. But in the case where the organization is having what? Limited resources. So in the case where they have limited resources, in the case where the organization is having limited resources, it means that, assuming, let's say, an organization who produces, let's say, what? Sobolo and let's say ice kinky. You see these things, they need sugar. They need sugar. I hope Sobolo too, they add sugar to it. So you need sugar, and the sugar is what? The resources that they are using in both what? The Sobolo and that of what? The ice kinky. But the sugar is now what? A limited resource. So the organization has to think about it. Should we produce Sobolo first or we should produce the ice kinky? You see that thing? So when it comes to this issue, we need to know the selling price of both products. You need to know the variable cost. So the moment you subtract the variable cost from the selling price of each of the products, you get what? Your contribution per unit. When you get your contribution per unit, then you need to what? Use the let's say the limiting factor to what? To divide the contribution per unit, and that one will help you to make you know whether you should what? Let's say produce this one first or produce this one let's say second. So that's it. Or when it comes to the limited resources as well. So this is all some notes, and let's say a simplified note that I would say that you should what? Get in mind so that it can help you when it comes to make or buy. So I will use a question. I will solve one or two questions so that it will help you to understand what I'm trying to bring across. So let's start with a question so that you understand it when it comes to the make or buy. So the make or buy that we are coming to, the question that we are coming to treat here will be based on the spare capacity. If that organization is having what? Let's say unlimited resource. So if that they have a spare capacity. Spare capacity. So one issue is that if you want to get the question that I'm coming to use to do the teaching, then the first comment section of our, let's say, our YouTube channel, a link to our Telegram page will be what? Will be posted there, or will be sent there, so that when the moment you tap on our Telegram page, the link, it will take you directly to our page, our Telegram page, and the question will be posted there, so that you can get access to even the relevant course question that I solved, and also any question that I will be doing. That's why that we are doing it. So the same questions are on the same document. So this one will be make or buy question, which is an example one. When they on our document, that's one example one. So when you go to our YouTube, when the first comment section, you'll be seeing the link to our Telegram page, and when you tap on it, you will be added to our page so that you get access to the question. Okay, so let's start the question. So the make or buy, the question that comes today is based on what? Spare capacity. So it means that the organization is having what? Unlimited resources. So let's see how that one to go. So let me read the requirement. The requirement says that determine the cost effectiveness of outsourcing the accounting activities and identify the qualitative factors involved. So what that they have given to us here is that they have the name of the company is KRS Co. That's the name of the company. So KRS Co is considering whether to administer its own purchase ledger or to use an external accounting service. It has obtained the following cost estimate for each option. So they have internal service department, and also they have external services. So now they are coming to consider whether they should, we are going to compare the cost. We see the one that is what less, then we will tell them that they should make this based on the decision rule of what? Make or buy. So the internal service department, these are the costs that they are bringing here. So internal service department. Internal service department. If the organization do make the order, let's say, make the system by themselves, that's what that they are going to. So the internally, these are the costs that they are incurring here. So purchase, the first cost is they need to purchase hardware or software, and the cost is what? 320 Ghana cedis per annum. So the annual cost for the purchase of what? Hardware. So purchase of hardware. Let me change my marker. Hardware or software is 320 Ghana cedis per annum, 320. And they have also hardware or software maintenance. Hardware or software maintenance. Or software maintenance. The cost also is 720 Ghana cedis, 750 Ghana cedis per annum. 750 per annum. Then they also have accounting stationery. Accounting station, that one also is 500 Ghana cedis per annum. Accounting 500 Ghana cedis per annum. Then they have part-time account clerk. So that one is 6,000 per annum. So part-time account clerk. Part-time account clerk. 6,000 Ghana cedis. So let's add everything up so that we get to know our total when it comes to them making it in-house. When it comes to KRS making the purchase ledger in-house. So they have 320 plus 750 plus 500 plus 6,000. We're having 7,570 Ghana cedis. 7,570 Ghana cedis. 7,570 Ghana cedis. So that's the cost when they are making it in-house. So let's see if that they go for it. If that they go out to buy it, that's the external services. Let's see how much that one too will cost. So external services. External services. External services. So the external services too, they have processing of invoice or credit note. So I'm coming, let me take off my marker is not giving me a this one. Okay, so we have processing of invoices. Processing of invoices. That one too is 0.50 per document, and it is like 5,000 per annum. So we need to multiply the 0.50 per the 5,000 so that we get the figure. So let me see, 0.50 times 5,000, because these calculations were all in annum, so we need to get it in what? Annum, so that we get to know the exact figure for it. So 0.50 times 5,000. Yeah, 5,000 documents per annum. So I'm having 2,500 Ghana cedis. Then the next option is processing of check payment. Processing of check payment. That one too comes at 0.05 Ghana cedis per check, 4,000 per annum. So that one too be 0.50 times 5,000, 4,000 per annum. 4,000 per annum. So this one too, we need to just multiply it, then we get our figure. $2,000. Then the last part of it is what? Reconciling supplier account. Reconciling supplier account. Reconciling supplier's account. So let me see if that figure is there. So that one too is 2 Ghana cedis per supplier per month, which is what? 150 suppliers. So we need to also multiply it by that so that we get the actual figure for it. So it is 2 Ghana cedis times, we have 150 suppliers. 150 suppliers. Then we need to multiply it by, because they said 2 Ghana cedis per supplier per month. So let me bring 2 up here. So let me multiply it so that 2 Ghana cedis times 150 times 12. So this one is also giving me 3,600. So let's add everything up to see the total figure that we'll be having here. So 3,600 plus 2,000 plus 2,500. 8,100. 8,100. So it means that if we make it in-house, we are going to incur 7,570 Ghana cedis. But when you buy it out, the external services, we are going to incur 8,100. So the decision rule when it comes to make or buy decision says that if the cost you incur in what making it is lesser than the cost you incur when you buy it outside, then it is better than how you make it. So based on these scenarios, when you make it in-house, you are incurring lesser than when you buy it outside. So the decision rule says that therefore we should what? Make it in-house. So that's what we have to do for that. That's what we have to do for that. Okay, so that will be the decision that we are supposed to make on this question. So this one will be example, let's say 1. When you check on our document, so when you go to our Telegram page, the document will be posted. So this question, KRS code, will be example 1. So I'll be doing example 2 when it comes to the make or buy. I will be doing example 2 so that it will help you to understand some other stuff. So this one is the first part of the question. Yes, so you can do it. So I'll be doing the second one. So the second question. The second question also, the requirement says that should Jackson Company accept this offer or continue to make the part internally? Should Jackson Company accept this offer or continue to make the part what? Internally. So let's see what that is in the question, then we make our conclusion on it. So like I said, the first part of the question was also asking us to check on the, let's say, if you are making, if that you are sourcing the work, what you should check. So some of the things that you should check when it comes to outsourcing a job to, let's say, an outsourcer is what you need to check: the reliability of the supplier, the confidentiality, legal issues, the lead time. There's a lot of things that you need to check. So that's some of the qualitative aspects when it comes to you outsourcing a job to an outsourcer. So let's proceed on with the second question. So Jackson Company. So the name of the company is Jackson Company. That one is example 2. Jackson Company. So Jackson Company is now making a small part that is used in one of its products. The company's accounting department reports the following per unit: cost of producing the part internally. So these are the costs. They have direct materials, which is 15, direct labor 10 Ghana cedis, variable manufacturing overheads of 2 Ghana cedis, fixed manufacturing overhead, which is traceable, which is 4 Ghana cedis, fixed manufacturing overhead, which is allocated, which is 5 Ghana cedis. And when I started, I told you that fixed manufacturing, fixed overheads and other stuff are not what considered. Only it is what specific fixed cost. That's what we can include as what a relevant cost. So we will be doing some adjustment here, and we see based on the scenarios that will be written and see whether the fixed aspect of it, should we include it or we shouldn't include it. So the question continued and says that depreciation of special equipment, depreciation, and we know that depreciation also is not what included as what relevant cost. So depreciation of special equipment represents 75% of the traceable fixed manufacturing overhead. And in the question they said that the fixed manufacturing overhead traceable is what? 4 Ghana cedis. They say it is 4 Ghana cedis. Fixed manufacturing Fixed manufacturing, which is what? Traceable. They say it is traceable. And the figure is what? 4 Ghana cedis. And they are telling us that we know that fixed manufacturing overheads, which is traceable, will never be a relevant cost. And also fixed manufacturing overheads allocated will also never be what? A relevant cost. But let's see what the note is saying. The note is saying that depreciation of special equipment represents what? 75% of the traceable fixed manufacturing overhead cost, with supervisory salaries representing the balance. So when you take 75% of what? The traceable of the fixed manufacturing overheads, then the remaining figure will be what? Supervisor's what? Salary. So if you want to know the supervisor's salary, it will be 25% because they are saying that 75% represent what? The fixed manufacturing overhead. So if you want to know the supervisor's salary, supervisor salary, it will be 25% of the 4 Ghana cedis. So 25% of 4 Ghana cedis, which is what? 1 cedi. So this one will be a part of what? The calculation that. So this one will be the one that we can include when it comes to we taking out our relevant cost. But the 4 cedis, 3 cedis of it is what? Depreciation. And depreciation is not what? A relevant cost. And also the question continuity also say that the special equipment has no realized resale value. The special equipment has no resale value and does not wear out through use. So the supervisor salaries could be avoided if production of the what? Part were discounted, were discontinued. If that the part of the production is what? Discontinued. An outside supplier has offered to sell the part to Jackson what company for 30,000 Ghana cedis based on the order of what? 5,000 parts per year. So here in this question you can choose to do it, let's say a total figure, or you can choose to go by what? A cost per unit. So they are saying that an outsider company, let's say an outsourcer has come to Jackson company that, oh, the part you people want to produce, we can sell it to you 30 Ghana. So that one will be what? Let's say buy when they want to buy externally. So that one will be buying externally. So the purchase price or the buying price is what? 30 Ghana cedis. So that's it. And you know that make or buy says that anytime we want to do, we need to check compare the purchase price or the buying price with what the cost that we incur when we make it what in-house. That's the marginal cost. So let's see how that one too is going to be. So we have seen it, and it's going with what? An order of what? 5,000 parts. So you can choose to multiply the 5,000 by the 30, and it will give you the figure that the total figure. Or you can choose to go with it by what? The cost per part, so that when we finish with this one, we can also do the adjustment. So now let's see if they are producing this internally. Let's see the cost that they are going to incur. Let's see the cost that they are going to incur. So producing internally or making it internally. So making parts internally. They have direct material. So you know that direct material is part of what? Marginal cost. So we need to bring a direct material. Direct material cost is what? 15 Ghana cedis. Then we have direct labor. Direct labor also is what? 10 Ghana cedis. Then we have variable manufacturing overheads. Variable manufacturing overheads. That one too is 2 Ghana cedis. And you see, when I was reading the question, we have fixed manufacturing overhead, but they said that it is traceable. And we know that fixed manufacturing overhead is what? Non-relevant cost, so we don't need to consider. But the question proceeded on and they give us some another info that the part of it, which is 75% of the 4 Ghana cedis here, represent what? Depreciation. So the remaining was supervisor salary, so which is 1 cedi. So we need to bring the supervisor salary. That one will form part of what? The marginal cost, supervisor salary. And that one is what? The 25% of the 4 Ghana cedi, and it gave us 1 cedi. And the last part of it is what? Fixed manufacturing overhead, and it is allocated. Fixed manufacturing overhead allocated is not what? It's not a relevant cost, but rather it's what? Non-relevant cost. So we don't need to include that as part of our figure. So let's add everything up to get to know the total cost when we are making the part internally. So we have 15 plus 10 plus 2 plus 1. So it's giving us 28 Ghana cedis. So it means that if we manufacture the parts in-house, we are going to incur 28 Ghana cedis. And if that we go and buy it out, we are also going to incur what? 30 Ghana cedis. So, ladies and gentlemen, if you are based on the decision rule of what? Make or buy decision, everything tells us clear that so far as the marginal cost of making it in-house, it's lesser than the buy-in price. Therefore, we need to make it in-house. So that's the conclusion. So when you finish with this one, you need to make your own conclusion. So even though in the question they gave us 5,000 parts, you can multiply the 5,000 by the 28, and you get the same thing. You can multiply here by 28, you get a figure. You can multiply here by the 5,000 also by 30, you get a figure. So when you compare the two, you can still see that still the marginal cost of what making in-house is what lesser than buying it what outside. So ladies and gentlemen, this ends our make or buy decision calculation. So we will be creating more content, but this one is let's say our small thing that we say we have done. I do believe if you follow this one carefully, you'll be okay with getting, let's say, more idea when it comes to the make or buy what decision. So this one ends our what? Our part, let's say part 2 when it comes to make or buy, specifically the decision making, when it comes to the short-term decision making. This one is let's say the question that we have done, so that you understand when it comes to the make or buy decision. So thank you very much. Continue to subscribe or follow us on all our social media channels, so that you get what exclusive videos when it comes to whether management accounting or financial reporting or even financial management. We have great content that we are about to create, so that you'll be able to understand more things as well. So thank you for choosing an Executive Masterclass Tutorial Center. And as we say, our motto is what? Our motto, I hope you still remember our motto. Our motto is an icon of what? Academic excellence. So we are here to provide or give guide and also support you with all the necessary things that you are supposed to know, so that it will help you when it comes to your academic journey. So see you in our next video, which that will be doing video on that of what? The limiting factor and throughput accounting ratio. Thank you.